Hey guys, what is going on? Welcome back to the portfolio. Welcome back to the channel. Great to have everyone back on the YouTube series, back on my Robinhood portfolio. For today's video, I want to do a quick update on the overall performance of the portfolio over the last 1 week of trading. And more importantly, talking about a very easy and powerful strategy for making income on your portfolio, for making extra income apart from your stock trading. And that is by selling off covered calls. If you guys have watched the channel in the past, you guys will understand that a lot of the gains I've made on the portfolio has been through selling off covered calls. It's very powerful and it's very easy. A lot of the options contracts that you can get into are very complex, but this is a very easy way of selling off stocks you have in the portfolio, buy and hold stocks, blue chip stocks you have in the portfolio, and making extra income on those with very little risk at all. So I want to talk about that in today's video. Before we do that, let's take a quick look at the overall portfolio. As you can see here today, up a nice 1.13% in the green, 6,660 in the green. But you can see up on top, the portfolio is also down quite a bit from last week, currently at 593,755. Over the past 1 week of trading, you can see it's down a quite noticeable 4.2%, 26,042 in the red. 1 point getting up over 623,000, 619,000 here starting the week. But it has dipped down quite a bit, and you can see the 3-day holiday weekend as well. Monday was not a trading session here, as you can see a flat line on the 5th of September. So it's going to be a short week this week. But let's go over to options. You can see all of those on the portfolio currently. On this side, I have some cash secured puts, but today we'll be talking about covered calls, and this is what Boeing here is. A Boeing 150 call, 9/16 expiration, 12 sells. This is a covered call. So I have Boeing in the portfolio. I have 1,200 shares in the portfolio, and by having those in the portfolio, I receive income by selling off contracts. So you can see a -12. This means I sold off 12 contracts. In doing so, I got 5,232 credited to the account, and this is every week. I can get this kind of premium every week. But the stock basically trades where it's at. If it trades sideways, I can get this reliably every week. You can see, however, if we take a look at 1 week, 1 month, these options contracts are very volatile. This is why a lot of people get into options contracts, especially buying contracts. You can see at one point it was $25 on the 16th of August, and then fast forward here, beginning of September, it's fallen all the way to $6, and that can go the other direction as well. So if you bought this stock, you'd be making quite a bit, if you bought the contract, you'd be making quite a bit of income on that as well, because you can essentially buy it here and then sell it back here. So they would be doing the opposite of what I'm doing here, is by selling off these contracts. But again, I already have the stock in the portfolio. If I'm okay by selling it off at 150, I can still make a profit plus all of this premium per week. So this 52.32 I can make weekly, no matter what the price of the stock does. Yes, if the price of the stock does start going up quite a bit, this is going to go down, and I'll have to start rolling these contracts, which I have been doing prior, which we can take a look at here. I rolled a contract from 9.9 to 9.16. I did roll down a bit from 155 to 150, and I rolled out from 9.9 to 9.16. So you can see here I bought contracts back for 149 and then sold them off for 585. And in total, I received 5,232 by selling off 12 contracts, essentially at $4.36, the 585 minus the 149, roughly. So that is what I've been doing on the portfolio, and you can do this repeatedly. The biggest issue is which stocks to use and which contracts to get into. So the stocks that you want to pick for this strategy are like Boeing. Blue chip stocks, long-term buy and hold stocks, they'll be around for 30 years, that have a very durable competitive advantage in their industry. Boeing is a very large aerospace company. So even though over the past 1 year of trading, it is down quite a bit here, or let's go back to the stock actually to show the price of the stock. So even though it's down over the last 1 year, in 5 years here, it's pulled back quite dramatically. This is a stock that can easily get back to this range here. This is a large aerospace company. There's not very many of those that operate, so it's very hard to get into this industry, and this is a defense stock as well. So I think the U.S. government would also want to support this company because this is very vital to its military complex as well. And so this is a stock that is not going to go away anytime soon. There's no risk of bankruptcy with this stock. And by holding the stock in the portfolio, you can sell off these contracts, making quite a bit of premium. So that's the type of stock to get into. A blue chip stock, Boeing, for example. It's not going to go away for a long time. This is a buy and hold stock that you have in the portfolio, but you don't mind necessarily selling off at a particular price. The other thing to do is when you do select the stock, which contract should you get into? So now that we got the stock we want, let's go ahead and go over to Boeing trade options. This would be for any stock that you want to do options trades with, the covered calls with. You want to do sell call. That means I have the portfolio, or excuse me, I have the stock in the portfolio. I'm going to sell off a call, meaning I'm going to sell off at a particular strike price here that I'm more than happy to sell it off for. For example, if I put 155 and the price of the stock is above 155, I'll have to sell this price. I'll have to sell this stock off at this price by September 9th here. I can also change this as well. So 16th, 23rd, 30th, giving the portfolio more time, and I receive a little bit more premium for that. But this is the price that you're going to sell it off for. So if you're not comfortable with 155, you can do 157, but you'll see the price that you can get for the premium will also go down. So instead of receiving 152, I'll receive 80, 38, because there's less risk the higher the strike price. The lower the strike price, you can see you'll get more premium because there's more risk. And down here, you can actually sell these off for lower than what the price of the stock is. So unless the price of the stock drops, or you buy back this contract, you'll have to sell the stock off at 150, even though it's currently at 152. So that's the risk, the upside risk. You're going to limit yourself on what the maximal price you will get for the stock. But as we'll see, we can roll these stocks as well. You can buy these contracts back and then sell off the next week, like what I did on the portfolio prior. So you selected the stock, you're selecting the contracts. What I try to do is calculate my cost basis. So what I do is I buy the stock, for example, let's say at 155. Let's say I do an options contract this week. I'll receive $1.52 per stock. Each contract is 100 stocks, so this would be 152 per contract. But you can take a look at it just with each individual stock. So I bought the stock for 155. I'll sell this contract off. I'll get $1.52 in the portfolio. So now my cost basis is 155 minus 152. So 153.48 if I did the math correctly. So next week, your cost basis is no longer 155, it's now that 153.48. And you can lower your price if you want at that point and get more premium. So you can kind of consider you bought it for 155, but the cost basis will be that minus this price here. So that is really how I determine what my strike price is. You can also take a look at some of the Greeks. Now this gets much more complicated. Delta here, for example, if you take a look at Robinhood, they have a page that goes over all of these Greeks here. I typically take a look at Delta. If we go down to Delta, you'll see that this is kind of a metric that represents the sensitivity of an options price to the changes in the value of the underlying security. In other words, how much does the price of the option go up or down based on the price of the security going up or down. It also gives you a little bit of an idea how likely that is to be called away. You can read through that. I'm not sure where it discusses that, but for example, if it's 36, there's theoretically a 36% chance that this contract will get called away at that price. If you go up, for example, 165, you see that goes way down to 3%, 0.0379. And there's also kind of a weird thing on Robinhood on the desktop platform. I want to take a look at the mobile app as well. I'm going to pull both of those up here. Again, on the right here, I have the desktop, 156, or let's go back to 155 just to make this clear. 155. Now on the smartphone app on the left side, let's go ahead and do that same contract. So let's go down to Boeing. Let's go into trade. Let's not roll. Let's do trade options, view all options. September 9th. Let's go down that same contract. I just want to point out that this delta should be positive. So here you can see it's negative 36. But if you go to the smartphone app, you can actually see it's positive 36. I'm not quite sure why it's showing it differently here, but essentially a covered call should be positive here. Maybe a way in how they're calculating the profit on the trade. I'm not quite sure. If anybody knows in chat, please let me know. Let me know in the comment threads down below why it's showing differently. Desktop version, again on this side, showing 0.36 in the negative, but on the smartphone app here, on the left side, it's actually showing a positive 0.36%. So a little bit interesting there. So it gives you a little bit of idea. I typically try to have this between 20 and 40. But that'll kind of vary, again, off on my cost basis. If I'm very comfortable selling off a stock, that might go up to 50 to 60%. The current stocks I have, let's go ahead and take a look at those. Or current contracts, I should say. Let's take a look at those. So negative 12 here, again, I sold these off. The current delta here is 60. So that's the upper limit that I like to play around with. But for this stock, I'm well above my cost basis, my prior calculated cost basis. Yes, overall I am down. I do have this holding in other portfolios as well. My E-Trade portfolio, for example, has quite a bit of Boeing in it as well. So I'm not necessarily wanting to sell the stock off of this price, but I do think the price of the stock should be going down. I'm not quite sure, again, why this overall stock market, especially Boeing, has been going up. So I'm a little bit more aggressive here just because I'm kind of comfortable with the cost basis as well as comfortable, or I'm bearish on the stock. I think this will probably go down in the future. And I was trying to do this a couple weeks ago, if you guys remember from those prior videos, but unfortunately a mistake by Robinhood and a mistake by myself calculating how much margin I was using on the portfolio unfortunately prompted the trade not to go through. I had to buy those back at a considerable loss and then selling off contracts again. So overall I'm still up about $40,000 to $50,000 on those trades, but if you guys remember back to the history, I had to buy those contracts back for quite a bit. I posted that on a couple videos this past couple weeks. Tried to buy back almost $52,000 worth of contracts in order to start selling off covered calls again. So big mistake on the portfolio, but overall still up in the green by utilizing that strategy. So very simple, very powerful, easy way of making income on stocks that you already hold in the portfolio. So I hope that makes sense. It gets quite complicated. I think this is probably one of the easier options contracts to understand. You simply buy a stock, you have it in the portfolio. You have to have 100 shares. Each contract is 100 shares. But if you have 100 shares in the portfolio, then you can start going into, again, let's go back to Boeing and the stock. You can simply start going into trade options. So you have your stock bought, you go to trade Boeing options, you do sell call, that's covered call, you have that in the portfolio. And then you can start selecting which strike price. Again, I went through my very simple strategy for doing that, as well as expiration date, how long you want to do this. Essentially, like myself, I like to do weekly just because I like to play around in this portfolio. I have other portfolios that I do more long-term buying, hold investing, and really check those every couple months. But I like to do trading on this portfolio, so that's why I'm doing weekly options. But you can do monthly options, you can do quarterly options. It's really up to you on what expiration date to pick. But the more important thing is configuring your cost basis and then using some of the metrics like these streaks, for example. Delta is what I use. 36 here, 36% chance of being in the money at expiration. And you can kind of judge some of your trades off by using that. If you go up, for example, to 165, you can see that falls dramatically. And if you go down, this goes almost to 100% being in the money at expiration, meaning you'll have to sell the stock off for whatever strike price that you put in. So again, just wanted to quickly go through that and the portfolio. I'll end the video here. If you guys have any questions on that, please let me know in the comment threads down below, and I'll do an updated video. This gets quite complex, and actually all of the comments on today's video, I could probably expand on those quite considerably, about the Greeks, about what stocks to pick, my strategy as well. This isn't completely 100% scientific way of doing it, but this is a way that it's worked very well for the portfolio, and I'm going to continue using that strategy moving forward. So with that, I'll end the video. Again, if you guys enjoy the content on the video, if you guys enjoy the video series, feel free to like, share, and subscribe. Until next video, we'll see you then.